We're here to help you sharpen your work and make it as effective as possible.
Today we're looking at a really exciting financial analysis.
It's focused on NuScale Power, arguing that a recent 13% surge, which it ties to the AI energy story and high short interest, means the bottom is in and a breakout is coming.
Okay, let's just get straight into the analysis.
I read through it, and the conviction level is very high.
It's timely, for sure.
Absolutely. It's tapping into this huge narrative around AI data centers and their, massive energy needs.
And how SMRs could be the solution?
Right. But I think that's the first area we really need to examine. Just how robust is that central catalyst?
That's the key question.
The connection that's drawn between these sort of general statements on future energy demand and NuScale's SMR tech specifically, it really needs more grounding to be a truly high-conviction catalyst.
I agree. The analysis report hangs that 13.5% spike almost entirely on a comment from a tech CEO on a podcast, just talking about nuclear energy in general terms.
The timing is compelling, I'll give it that.
Oh, for sure. It definitely looks like the fuse was lit there. But relying on that kind of indirect link, without proving SMRs is the exclusive or even the preferred solution for AI, well, it weakens the whole foundation.
It's an assertion.
Exactly. It asserts that SMRs are the perfect fit, but it doesn't really demonstrate it. It doesn't show the proof.
I see what you're saying. The market might be making that connection intuitively, but for this kind of analysis report, you have to do the heavy lifting for the reader.
Especially for an expert audience.
Right. They know the energy landscape. They're going to ask, why NuScale over geothermal, or advanced gas, or even massive solar plus storage projects?
So the suggestion here is to really bolster that argument, to move beyond that one C-suite comment and integrate some hard, specific data that validates SMR's unique position.
Turn the narrative into something data-driven.
Exactly. Now, look, NuScale is still an early-stage company, so finding a direct contract with, say, Google or Amazon might not be possible yet.
That's a fair point.
So if we can't find that direct smoking gun, like an MOU, we have to build the case with what we do have.
So where would you start?
First, I dig into any existing agreements or proposals NuScale has, even with utility providers or smaller data center operators. Anything that shows an existing direct industry link the market might be pricing in.
Okay, that's a good starting point. But I think the really potent evidence is probably in the technical specs.
Tell me more.
The analysis could really analyze the specific power requirements that AI industry leaders keep mentioning. Things like guaranteed 24/7 baseload power.
Right, no intermittency.
Zero. And the small land footprint needed for siting these things right next to data centers. You take those criteria and you map them one-to-one directly to the unique design features of NuScale's SMR.
That mapping is crucial, because then it's not an opinion, it's a direct comparison.
Exactly. You're saying the AI industry needs X, Y, and Z, and look, only this specific SMR technology delivers that combination.
It shifts the entire focus from just general excitement to measurable technical superiority.
And to really drive home that perfect fit conclusion, especially for financial analysis, you have to bring in the numbers.
The money side of it.
Compare the capital costs. Or maybe even more importantly, the deployment timelines of SMRs versus the other options. If NuScale can get power online materially faster or cheaper long-term than traditional nuclear, that financially justifies the whole thesis right there.
And if the analysis can't find those specific points?
Then the perfect fit claim just feels like an opinion. And that 13% jump looks more like a one-off reaction to a soundbite than the start of a real trend.
Solidifying that link is everything. It makes the entire investment case more durable.
Okay, so that really covers the core catalyst. Let's pivot to the second big opportunity here, which is more about completeness and, addressing risk.
I agree. The report makes a very, very aggressive bull case, and it relies heavily on the short squeeze idea, which is a powerful hook, but
it can't stand on its own.
Not for a sophisticated audience.
Exactly. So to maximize this report's utility for an expert reader, it's essential to integrate a detailed assessment of the counterarguments, of the inherent risks, rather than focusing only on that short squeeze potential.
An expert wants to know that you've thought about the downside.
Of course.
And the analysis does a great job highlighting what we'd call the greed hook, right? The 30% short float, the $750 million in cash. Those are exciting numbers.
But
it completely neglects to explore why that massive short position exists in the first place. A short interest that high is a massive red flag. It's a dual-edged sword.
It's signaling a high level of perceived risk from a big chunk of the market.
A very significant chunk. And if you ignore that, the analysis just feels vulnerable, a bit one-sided. It's all about the potential profit from the squeeze, not the risks that created the setup.
That's a huge omission, because the expert reader already knows the risk is there. What they want to know is how you've accounted for it.
And why you believe those risks are wrong, or at least already priced in.
So the suggestion is pretty clear. Structure a dedicated, objective section. Call it the bear case. Outline the risks, and then show how the company's strategy or its financial position mitigates those specific concerns.
Confronting the bear case head-on. It actually makes the bullish conclusion much more credible.
It shows you've done the work.
You could detail the specific challenges the shorts are betting on, like extended regulatory hurdles, which are almost a given for a first-of-a-kind technology like this.
And project cancellation risk is another big one.
Huge. Or just the simple fact that it's going to be a long, long time before this company sees any real commercial revenue.
Those are the qualitative risks, but for our financial report, you need to make them quantifiable.
How would you do that here?
Well, the report already has the data point. That's $750 million in cash.
Right, it uses it as a defense against bankruptcy.
Which is fine, but it's a bit shallow. To make the rebuttal to the bear case really robust, you need to calculate the cash burn rate, figure out the runway.
I wonder, though, isn't just showing the cash balance enough for a speculative stock like this? Why is the runway calculation so critical?
It's critical because it frames the stakes. If the whole bear thesis is based on a 3-year regulatory delay, and you can show that $750 million gives them a 4-year runway at their current burn rate?
You've just undermined the entire short thesis with the balance sheet.
Precisely. But if that runway is only 18 months, then any small delay becomes an existential threat, and the shorts are right.
So calculating the burn rate relative to those major milestones, like regulatory approval or the first big contract, it shows why the cash is sufficient.
It turns a defensive data point into an offensive one.
I like that. And building on that, you could even introduce a weighted risk-reward matrix.
That signals real confidence.
It would explicitly balance that high-end, $60 bull case target against the real downside risks you've identified. It forces the analysis to be precise about its conviction.
Okay, those are all excellent points. We've talked about the evidence, we've talked about the structure. Now let's switch gears and talk about the delivery, the tone.
Right. The material is undeniably high energy. And that's great for engagement, but I think the aggressive tone might actually be working against its analytical goals.
I noticed that too. The language is very emotional, very dramatic, which is exciting, but it risks undermining the objective credibility you need in a serious financial report.
That's the conflict, isn't it? You have this consistent use of very subjective, aggressive terms. Exploded. The bears are trapped.
All caps, exclamation points.
Yeah, and it kind of diminishes the weight of the actual good technical data that's in there. You know, the analysis of the $19 support floor, the $25 resistance, that stuff gets a bit lost under all the drama.
The style feels more suited to like an opinion forum for traders, not a piece of robust investment analysis for an expert audience.
We want the conviction to come from the precision of the evidence, not the volume of the language.
And the author clearly has strong conviction, which we want to preserve. The goal isn't to kill the excitement.
No, not at all.
It's to elevate the diction. The suggestion is to keep that excitement, but to substitute the emotionally loaded terms with clear, objective, financial terminology that communicates the same urgency without sacrificing the rigor.
Exactly. Swap subjective interpretation for objective measurement. Like, think about that opening. SMR exploded plus 13%. Rocket.
Okay, so what's the alternative?
Instead of it exploded, you could describe the move as the price surged by 13.5% on 180% of average volume, indicating decisive institutional accumulation.
That is a powerful difference. It conveys the exact same movement, but it uses professional metrics, volume, to validate the observation. It tells the reader how it happened, not just that it happened.
Right. Or let's look at the language around the shorts. The bears are trapped.
Which is a very common phrase, but
it's a declaration. You could replace it with an objective observation. Heavy short covering activity following the breach of $22 amplified the recent momentum, putting significant pressure on the remaining 30% short float.
it validates the squeeze potential using market mechanics and technical levels, not just a subjective claim.
And one more. When talking about future prices, instead of the prediction, if we clear it, we fly.
Which is very exciting, but not very analytical.
Right. You change it to a structured technical statement. Something like, a decisive breach and hold above the $23.50 level confirms a continuation pattern targeting the critical resistance zone at $25.00.
It still has that high conviction, but it's grounded in conditional technical analysis. It makes the argument far more credible for anyone trying to figure out their entry and exit points.
The overall impact of those small changes is huge. You take an analysis with a great thesis and great timing, and you wrap it in the language of authority. It removes any reason for skepticism based on tone and forces the reader to engage with the facts.
Okay, I think we've covered 3 very distinct, very high-impact areas for improvement. Let's just quickly recap the actionable suggestions.
This has been a great discussion. I think this report is so close to being a really top-tier piece of analysis.